So welcome to Aon's 2020 Virtual Aon Insight Series. My name is Chris McLaughlin. I'm the Director of Aon Cyber Solutions in Australia, and I'm joined by Michael Perrant, our Cyber Insurance Lead. Today we'll be talking about how to make better decisions making in a complex and volatile world by utilising cyber risk quantification. So using risk quantification as a way to make better decisions isn't a standalone exercise. It's part of a broader cyber resilience strategy that the organisation needs to adopt. Aon's approach is a cyber loop. We look at 4 component parts of a strategy, and by no means these are linear. We understand that all organisations are at different points of their journey in terms of the cyber resilience. So we've picked out the 4 key areas that are important for organisations to understand and assess, which really do support better decision making for an organisation in terms of decisions around total cost of risk transfer and cyber resilience. So the components of the cyber loop are assessment. So assessment looks at all types of different assessments that organisations can undertake, from standard controls assessments against international better practice standards, to vulnerability assessments, to penetration testings, and advanced adversary simulations. Quantification looks at understanding the value at risk to an organisation and the impacts on the balance sheet and the potential losses that an organisation can face through a cyber attack. It also talks to the adequacy of the insurance programme and leads to better discussions and outputs with the insurer. The insurance is obviously the major risk transfer option that we advocate to organisations to remove some of that risk from the balance sheet. And incident response is becoming more and more important for organisations to get right and to practice with all constituent partners within their ecosystem to make sure that they can manage an incident more effectively. And we see this as instrumental in organisations managing cyber resilience and coming out of the back end of an incident in a much more effective way with sort of limited losses and limited disruptions to their business. And Michael, I'll pass to you because I know we've got some recent examples where we work with clients on the cyber loop that they've taken each of these components, which have led to a better outcome in terms of their insurance.
Sure, thanks, Chris. So as mentioned, many clients are on a different journey and they're entering this particular loop as and when is fit for them. But one that I personally worked on about 6 odd months ago now, this particular client was getting contractual provisions, contractual requirements for cyber insurance, which up until a certain point they had been able to negotiate out of, but they were at a point where they needed to start looking at this in a different light. So they actually started from the position of taking the assessment on board. So they moved from the, this is a contractually driven requirement, something that we need to do in order to continue operating, to, well, actually, we're getting this so often, let's try to understand what this risk is, because we don't necessarily want to buy insurance just for the purpose of a ticker box exercise. So they'd gone through the assessment process, which helped them to identify just what kind of key exposures they had as an organization. And that, for them, critically opened their minds to what kind of worst case scenario, what a bad day could be for them from a cyber lens. The next step for them was to actually start quantifying what that actually meant for them. So again, contractually, they were being required to procure a small limit of indemnity. They actually decided to undertake an assessment, the quantification step, to understand what that actually meant to them from an insurance perspective. So again, looking to align the assessment with the quantification piece to not only meet the contractual requirements, but to actually provide proper advice to the internal stakeholders, as well as potentially look to then move to the insurance aspect, which was then aligning a risk transfer solution that actually made sense to them. So we started at that point from a company that was looking to potentially meet contractual provisions through to the quantification, really understanding what a bad day could be for them, and then building an insurance program around that. The insurance program itself was then manipulated to be as fit for purpose and bespoke to that organization and their exposures as possible. The quantification exercise identified some risks that they'd never contemplated as an exposure to them, and we were able to map a good number of those to their insurance policy, giving them not only the contractual provision requirements that they needed, but also true risk mitigation and transfer. The final step, which is an ongoing process for the client, is to then integrate their incident response capabilities and augmenting that with their insurance response that they now have. The major key for them was to understand what that means for them and making sure that the insurers are on board for what they need, and when that day eventually comes, that it should be hopefully as seamless as possible for manage that incident. That's all I really want to say for them for when it comes to the cyber loop and how they manage that particular process. I'm finding that more and more clients are starting to realize this sort of exposure, and I can hand on heart say that the insurance is starting to walk hand in hand with those sorts of risks.
Thanks, Michael. So I think briefly we just want to discuss why there's a move to quantitative assessment from more traditional qualitative assessments. And this is pretty much driven by two things. One is the organizations no longer have this sort of castle and moat type security posture. So we don't have perimeters and assets inside the walls that we can protect easily. You know, through digitization, through the adoption of cloud, social, big data, machine learning, artificial intelligence, provision of services from a whole number of partners and providers and new entrants into the market, that this perimeter is expanded massively. And so to try and understand the risk that a sort of cyber attack would pose to your organization just by doing this, sort of simplistic qualitative assessment, which is, sort of more subjective in nature and relies on the skills and experience of people within the organization, we're seeing a lot of our clients are moving to this sort of quantitative assessment that understands the complexity of their environments and takes a much more mathematical approach in order to try and identify what the sort of value at risk is. And we do that for a number of reasons. We want to make sure that we understand, through the modelling that we do, that the key scenarios that are going to lead to the most significant loss and the types of costs that are going to be incorporated into that loss. So, that falls into the insurance and the risk transfer. We also use it for a way to communicate more effectively with boards and executives. That we know that quantitative assessment is used widely across organizations for other operational risks. And what we want to try and do is get to a position where cyber risk is quantified and reported in similar ways the other operational risks are reported to executives, so they can make more informed decisions, based on what are the capital adequacy requirements in the case of a significant cyber loss? What's the impact on their balance sheet if a loss occurs? What's the total cost of risk management? And how should they align their cyber program to make sure that you're getting the proper return on investment and that what you're investing in is actually mitigating the greatest threats to your organization? One thing I would say is that I wouldn't discount qualitative assessments totally. They're great for sort of broad risk assessment across all of your risks. But what it is an indicator to point to what are the most material risks to your organisation, and then those risks should actually be quantified. And whether that's purely sort of cyber risk or a tech risk, I think that they're more likely to go hand in hand. And we also need to take into consideration the systemic nature of risk now with, sort of common infrastructure and common vulnerabilities. What would have been a sort of threat actors approach to compromise an organization after, and just looking at a target to carry out one nefarious act, we're seeing that it bleeds into supply chains much more easily now. And quantification is a good way of looking at the risk, not just as it impacts you, but also as it flows through your supply chain, which is becoming more and more important to regulators. And you see that through some of the APRA regulations and through what other regulators are saying in Australia and globally around managing third-party risks, and understand the long tail of your risk that has to be understood and managed more effectively. So moving on, I mentioned some value in risk quantification, but I think one of the things that we see consistently from conversations with insurers, and I'll pass to Mike in a minute to discuss this, is that we see that there's this continual evolution of new threat actors, new tools and techniques that are being employed. Through COVID, we've seen a massive uptake in cyber attacks from all actors across all sizes of organisation. They're collaborating more effectively now than they ever have, which is making a lot of insurers very nervous about, how to underwrite this risk, because it is now so pervasive and it's so damaging, not just to an organisation, but to the broader economy. And Mike, I just want to pass it to you just quickly to talk about what you're seeing from the insurer perspective in terms of that frequency of attacks against organisations that's leading to significant losses and claims, but also what the insurers are saying about the aggregated losses that organisations are suffering from cyber attacks.
Yeah, sure. Thanks, Chris. So probably maybe taking a slight step back in time, ransomware was this, an annoyance. It caused some damage to a couple of organisations. It certainly don't want to downplay it, but it's nothing like what it is now. It has been truly weaponized. In fact, it's probably nuclear weaponized now. So we've gone from insurers understanding this issue with ransomware in particular. Insurers were also then at the same time worried about aggregated concerns. So very dissimilar to other lines of insurance, a fire will burn an area, an earthquake will damage an area. Cyber can be the equivalent earthquake within cyberspace can be anywhere in the world. It can be many organisations depending on what the nature of the attack or issue is. So insurers were worried about the single event, but also the mass event, if you will. Slowly but surely, over the last maybe 12 months now, ransomware has come to dominate the discussion. That brings together the combination of frequency and severity. So we're seeing far more organizations being impacted, and the impacts of it are now being quite devastating. It's to the point where insurers are asking more questions around ransomware than almost any other topic. That's not to say you should ignore those other topics, but that is the number one issue that insurers are asking their insureds. What are you doing to prevent this? What else can we be doing to prevent that? So we moved from the focusing a bit on the individual as well as the mass effect to right now, the number one issue being focusing on that individual incident. You will be impacted by ransomware. Insurers are making that assumption. You will be impacted. What are you trying to do right now to mitigate that? As soon as they start then turning their minds to what this might be again on a mass effect, so a significant ransomware attack that is propagated throughout global networks, again, that will move the needle quite heavily. It's to the point as it is where cyber insurers are starting to really look at the viability of this line of particular coverage and throw into that some complications that we're seeing now in certain jurisdictions where the payment of ransomware or the payment of ransoms may potentially be compromising some legislative issues. We may indeed find that this is something that is so pandemic that insurers' hands are forced, let alone of their own accord. So trying to paint the picture there that this is both an individual as well as a holistic issue that insurers will not ignore.
Thanks, Mike. And I think off the back of that, for insurers trying to understand this risk and project what the future losses are going to look like is incredibly difficult. And that's due partly to a lack of historical data. I mean, I think it's right to say, Mike, that we've probably seen more claims in the last 12 or 18 months than we'd seen in the previous 5 years. So, there's not that amount of historical data that insurers or organisations can look at and say, well, this happened in the past, so it's likely to happen in the future. And, I think to your point, one of the things talking to some of our partners is it's not just the ransomware that's an issue, but it's the ransomware coupled with the extortion of releasing data, which is causing a lot of issues for organisations to try and understand the true sort of potential losses of organisations. And so that's really where the quantification comes in to really help you make those decisions about potential losses, impact on balance sheet, capital adequacy requirements, total cost of risk management, because it gives you a point-in-time assessment that you can look at for your organisation without relying on generic benchmarking data or generic data that doesn't really give you the insights that you need in order to make those decisions in terms of resources to mitigate the risks, or for your insurance purposes to transfer the risk out. And I think, Mike, just on the final point here, we've done a lot of risk quantification exercises over the last sort of 6 to 12 months with our clients, and we've seen a really good outcome, both in terms of the limits and the wording and the insurer response. Could you just spend a couple of minutes discussing your experience and the direct feedback that you've had from the insurance market?
Yeah, sure. So again, quick snapshot in time. Cyber market, cyber insurers were starting to learn their craft, if you will, getting to the point, getting to the heart of good questions. That sort of 3-year, 4-year journey, we're now at a point where many of these underwriters are very sophisticated, so they understand some of the challenges that organizations have. And we should overlay that with the comment that insurers expect companies to not be perfect. It's impossible to be perfect. Insurers expect that there are going to be some challenges, but what they really, really want to hear is that an organization is aware of those issues, is aware of the challenges that they've got, and that they have a plan to remediate those. And quite literally, get on calls with some of these underwriters. The level of sophistication around the environment that you are operating in is quite important. It's critical to them, because they need to be able to demonstrate that they are now across these risks themselves. It's to the point where insurers are no longer even relying just on the submission information that you provide. They will also partner with external parties to do an external assessment as well, to say you are good, bad, or indifferent. So they're now getting external parties who are experts in their own particular fields, augmenting that information with the information that you provide, and then coming to you saying, well, please tell me about these particular ports. They seem to be compromised. What are you doing? Can you explain how and why the mechanisms are in place to manage those? We can't underline the importance enough of being able to have a story behind those particular vulnerabilities and what you're doing from an awareness perspective. So gone are the days of insurers not looking into this in a lot more detail. Thanks, Chris.
Yeah, and I think that's a really good point, that insurers are becoming a lot more proactive, and there are a lot of tools and companies out there that do these external vulnerability scans and scoring against what they see from externally available information that could potentially indicate that an organization is vulnerable to attack, coupled with the threat intelligence, the sophistication of threat intelligence now, where organizations can actually find leaked credentials from your organization online. You have to be able to have a way to have a discussion with the insurers around, these may have been leaked, but these are our sort of critical assets, and that's how they're protected, and we know that through the sort of quantification exercises that we cover. So I'll briefly touch on Elons' approach to risk quantification, and we take a scenario-based approach. We look at, in conjunction with people from across the organisation, from business, from finance, from IT, security, risk, and obviously insurance, to try and understand what's critical to you and your organisation in terms of your assets and your technology. We look at what scenarios are likely based on what we see from the threat actors and what they're doing against similar types of organizations, and we overlay those types of attacks against the scenarios. And we look at really the commercials around what is feasible. So one of the things that a lot of organizations, I think, struggle with is this combative nature between risk and security and the business around how best to manage the risk and who owns it and who's going to be responsible for it. And so this approach brings all of those stakeholders together so we can help, bring out the expertise of the organization to look at what those sort of leading indicators of risk are. And so we get the right scenarios that can be quantified, and we get the right potential loss value against those scenarios. And so when we move into sort of financial modeling, we spend a lot of time with clients trying to understand the organization and the financial data that they've got. What would the business interruption activity look like for your organization based on how your business processes work? And then we would go into first and third party loss modeling, which gives you a good indication of what's your maximum potential losses and what you should actually do with that. And it helps you with that decision making around how much of that you want to retain with your organization and how much you want to, sort of transfer into the insurance market. And then the final bit is we do some stress testing to make sure that all of the assumptions that we've gathered from your organization are actually reliable and they're sort of true. So all of that tolerance testing against the risks, and then evaluating some of the controls around what you do in terms of your disaster recovery, your BCM, your recovery time objectives, and all of that type of stuff. So it gives you quite a robust model and approach and how to sort of quantify the risk. That the insight really comes from your organisation. We just overlay it with all of the insights and data that we have, in terms from loss and claims that enrich that financial model. Again, to give you the best insights to make the most appropriate decisions. And so, on top of that, a lot of organisations say, right, okay, well, we've quantified the risk and we understand the losses. Well, how well have we protected that value at risk? And so what we do is we model the sort of threat capabilities of the actors that attack organisations like yours, and we do a threat model against each of the scenario that says, right, for a sort of data loss scenario that we've identified, these are the type of threat actors that have been proven to come after your type of organisation, and we use better practice models in terms of identifying the threats and looking at their techniques and practices that they employ to attack your organisation, and we follow that through to the asset. And so, we get a lot of comfort in that to say, right, okay, well, we know that there's maybe 100 controls that protect these assets. So how well do each of those controls actually operate? Both from a design and an operational effectiveness, to say, are there weaknesses? Could the controls be exploited in order for the attacker really to get to that value? And I think that's been a really powerful message to the insurers. So we've quantified the risks, we've understood the value at risk, but then we've also done a threat model that supports the scenarios that we've identified. And off of the back of all of that, sort of one of the primary reasons to do with quantification is to determine that financial materiality and what are the potential losses to the organisation, but also how your insurance policy would react and what type of services it would actually pay for. So I'll pass back to Mick again. If you could just explain, this gets more into the dynamics of how the policy responds to an incident, but these costs are very significant for organisations, and especially when we talk about incident response, the cost savings from moving away from an arrangement you've got with an incident response on a retainer versus what you can extract in the skills and expertise, from an insurer panel. So Mick, I'll pass over to you for a few minutes.
Yeah, thanks, Chris. So again, touching on it, Chris mentioned that these are the types of things that are typically covered under a cyber insurance policy. And the two things that we've had maybe the three things that we've had a bit of a misalignment of understanding of here in Australia are your incident response, your legal liability, and business interruption. It's a totally fair position to be in because all we have had for the last 15 years really is the US model. And the US model has and still is very focused on liability. Liability is obviously important, but it's not quite the same here in Australia as it is in the US. So Australia aligns very much to the rest of the world, including London, UK, and EMEA, in regards to incident response being probably more important, and your business interruption almost certainly being more important. And this really hit home when, for me at least, and my global counterparts, when the WannaCry Not Petya issues popped up from, I think, 2017. Quite literally, the US was on a global call with the US, so they said, wow, we finally get it. Business interruption is, wow, really, really important. So that started this whole realization of the criticality of business interruption and the expenses of incident response. We found here in Australia, incident response is probably 2 to 3 times more expensive than it is in the US. And that's not anything unexpected. There's lower levels of competition. It's a newer skill set. So these particular vendors are maybe needing to focus on some slightly higher rates than what we might see in the US. There's more service that needs to be done, maybe potentially getting to a higher level. The work that we do with Chris brings all of that into the understanding. So when you speak to your clients, when I'm speaking to a client, I can say incident response will probably cost 2 times, 3 times more than what you're anticipating. Then we move into the business interruption. That is a dark art in its own right, which has been quite challenging for organizations to get their heads around. And that's probably, again, a fair statement, because we're talking about this intangible world where organizations have not really had a lot of time to really focus on this, to really value these sort of assets. And again, to underline the comment that Chris made earlier, these assets are becoming more and more important, more and more critical to operations of businesses, and becoming more and more valuable. So when something goes wrong, the impacts tend to be magnified compared to what we've seen thus far in the US from a pure business interruption perspective. So pulling all of these together into an insurance policy, we can then start making much more precise decisions, precise advice around saying, you want incident response, you want business interruption, it needs to look like this. And if it does look like this, then you need to start thinking of limits that are maybe at this level compared to where we're at right now, if you are looking for true transfer of risk.
And then that's like squarely where the quantification fits in, because you've got to understand those potential losses in order to structure those policies to get the right components based on what you see as an organisation and your risk appetite. And so when we bring all of this together, you really sort of then get this insight into what's your sort of total cost of risk management and optimising that cost for your organisation. And that is about, understanding how well your controls operate against the scenarios, so that you can articulate to, not just insurers, but to your boards and executives, that you understand the cyber risk the same way that any other operational risk is understood within the organisation, and you can articulate it in the same way. And having spoke to a lot of boards over the years, I think that they're all moving away from the need to sort of see qualitative assessments or cyber risk is very high and we'll get it to a high, and they really want to see those hard numbers and what the impact is going to be on the organisation and ultimately the balance sheet. And as I mentioned before, regulators are more interested in cyber events that lead to sort of issues with capital. And so pulling all of that together really does give you that insights to make those better decisions sort of based on quantitative data rather than just a qualitative assessment. And to finish off, I think there's a few key takeaways that we'd like you, to think about and take back to your organisation. The first is, sort of perform that qualitative analysis against, all of your risks to identify what is material to your organisation, and then spend the time and effort quantifying those risks. But when you quantify, make sure you've got the right model for your organisation that gives you the right insights based on what you're trying to achieve, whether it's around alignment with operational risks or whether it's around transferring that risk out into the insurance market. The right model is going to be critical to get the right output. And I think that quantification is going to become much, much more important for executive reporting across the board. I think it's going to be driven by boards as they get more articulate with cyber. They're going to want more granular insights and information. And I think, from what we hear from regulators here in Australia and from what we see elsewhere, this is going to be a mandate at some point that quantification will not be, a nice to have, it'll be a must to have. And then make sure that you have all of the right inputs, all of the right claims and loss data if you are going to use it for that risk transfer. So that's all from me. Mick, any final comments from you?
Look, the final comment I'd make is document the process, document the outcomes, document the improvement plans. That does two things. Obviously, it informs the board, it informs the executive, and it helps drive direction. But it also forms the basis of a very good presentation to insurers to help mitigate that risk, to transfer that risk.
Okay. Well, thanks everybody for joining Aon Insight Series Virtual 2020 conference. We'll now sort of close out. And if you need any advice and guidance on how to quantify your risks and get a better insurance outcome, then feel free to contact Aon.
Thank you, everyone.